Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. First notice date for September corn is tomorrow, and as we can see on the chart, we saw a continuation pattern occurring on this chart, which would indicate that as the market made its dip into this move, that we would see a similar move on the outside. And given that, we saw a potential target somewhere near 330.25. Today we hit that number pretty much right on the nose, and the market continues to decline, and we anticipate that the market will continue in weakness with minor pullbacks in between. The next target that we'd be looking at for the September corn contract sits at about 320.75. Whether or not it could quite get there over the next couple of weeks remains to be seen, but continued weakness is what we are anticipating for the corn complex in general. After clearing the 360-degree mark, the next viable target that we would be looking at is 326, and it looks like the market could very well make that by the close of this week. The December contract has a similar formation with the exact same continuation pattern, and as we can see here, the market is now very close to coming into potential target of 342.5 that we had for this contract. By the close of this week, we think 342.5 is realistic, and beyond 342.5, this market can decline somewhere in the neighborhood of 330 over the next several weeks. We do have a potential time factor setting in the middle of next week, which coincides with the Labor Day holiday that's coming in, and so we could very well see the market continue to decline going into the Labor Day holiday, and from there we could see a small bounce before the market continues lower. The December contract is right up against our 360-degree price factor of 344.5, and given the way in which it reacts to this area here, we probably have a target projection of about 326.25 before coming off the board. Two time factors that are in play for the December contract would be 5th as well as 19th. What we would be looking for here is to see whether or not the market continues to decline going into the 5th. Upon doing so, we could see a small bounce moving up into the 19th, and from there continued weakness back down after the 19th. That would be optimal, give or take plus or minus 2 days either side of these time factor dates. Last week, we gave you resistance at 944.75 for the week, and that's exactly what held. In fact, not only did it hold last week, but it apparently is holding very well this week. We suggested that the market, upon reaching this 944.75 area, would then find resistance and then look to retest previous lows near 917.25. Today is a pretty sizable down day for this contract, given the range it's been in over the last week and a half. We're very close to reaching that 917.25, and in all likelihood, we're looking at a possible price projection down to about 910 to 912 by the end of the week. The 912 price threshold happens to coincide with our 360-degree price factor of 912.75. And so we would be looking for here to be a nice spot for the market to find support as we look to close out the week. November beans made a very interesting high over the last couple of days. On Monday, where it came in and touched up against two of our time angles. We had a 2x1 downside angle intersecting with a 1x1 upside angle. And in addition to that, we also had a quartile level across the market. The intersection of all these points came together, and the market pinpointed for us a very accurate high for the market on Monday. Upon hitting this number, the market has since been in decline, although it's not as weak as the September contract. Like the September contract, we anticipate that previous lows will probably be eclipsed, although that may not occur this week for this contract. Perhaps early sometime next week, we could retest the 920 mark for November beans. The bottom end of volatility-based support sits at 919, so we like that target of 920 or so for this contract, again, either at the end of this week or early sometime next week. In doing so, the market could very well continue lower, and the next price objective then would be somewhere in the neighborhood of 890. Upon getting to about 890, I think the market then is probably exhausted, and at which point we can see a bit of a moderate bounce from there. Wheat futures continues to be very weak, and we had a potential time factor coming in near August 24th. Once this August 24th timeline came into play, we got a very small bounce and the market moved up into this timeline. And in doing so, after finding a small support, it then came back down and finally did hit our minimum price objective of 398.5. In fact, it came all the way down to our quartile level of 395 3/4, and from there we saw a small bounce. The next important time factor that we're looking at now sits on September 5th. We anticipate that this market will perhaps come off the board somewhere in the neighborhood of 382, and this could very well be the area where the market finally rests before coming off the board. The lows that we're seeing today are in line with the 360-degree mark at 398 3/4. Additionally, we are also sitting right inside of volatility-based support. And so it could very well be that the market does move a bit sideways over the next couple days, especially as we head into the Labor Day weekend. The December wheat contract also reached our minimum price objective, hitting 424 today. And this contract we anticipate will continue to move lower over the course of the next several weeks. Next price objective we would be looking at then is 397 3/4 and possibly lower for the December contract. December wheat is currently in an overlap of volatility-based support, and in reaching this area here, we could see the market at the very least find a bit of consolidation. Alternatively, we have a potential target near term, either this week or next week, where the market could reach 412 3/4, and upon getting here, we would reevaluate the nature of the strength or weakness at which the market lives at that time. Not much has changed for December crude. After failing to eclipse that key number of 51 for this contract, the market is now back down and is trading inside of this key support level near 47.69 to 47.10. At this area here, if the market cannot find some strength and if it breaks down below 462.36 prior to being able to regain about 475, we anticipate continued weakness with the possibility of a retest of previous lows near 43.90. The market now sits at a very critical zone, and in conjunction with the dollar potentially finding some strength, we could see continued downward pressure for December crude. The US dollar mounted a very significant rebound between yesterday and today. It posted an end-band support reversal up against volatility-based support, in conjunction with hitting one of our 360-degree price factor marks of 91.95. The market continues in strength today after posting that very strong reversal. And if the market is again able to get back above about 93.88 over the next 2 weeks, we think then that a significant low is in fact in place, and we could see a significant rally from the dollar from this point forward. Our bias is that if the dollar has not already done so, that a major low for the US dollar is due to hit very soon. After December cotton started to decline, we made a suggestion that the market would either break 61.15 or 69.85, whichever side that it breached first when it was trading in the area of about 67 and change, we believe would determine for us the direction in which this market could very well go. If it were able to get above the 69.85 number prior to breaking the 66.15, we suggested that the price objective of 72.15 would be back in play, and it looks to be exactly what is occurring right now. We didn't anticipate the devastation that we're seeing from Hurricane Harvey, and in doing so, this market looks very poised to come up and hit that target projection that we had. August 30th is a key time factor for this contract, and so as this market makes its way up to that timeline, it could either reach that target then, or we could see a small pullback before the market looks to turn back up again, given the nature of what we've seen from the hurricane in Texas and the fact that Texas is the country's largest producer of cotton. Thank you so much for joining us for our weekly market update. Look forward to touching base with you again next.